meeting last week, and the Federal Reserve basically showed their cards. As if it was a big poker game, they showed their cards. And I don't think he really has played any new cards this week. I think he's really trying to sell his policy. And it's important, too, I think what he's advocating is not just what the Federal Reserve ought to do, but he's advocating what Congress ought to do. And he's basically telling them that they need to provide more fiscal stimulus. That the Federal Reserve can lend money, but it can't really spend money. And that's what we need, is more spending. And so I thought that for me, the takeaway from Powell is that he's cautioning people against being too optimistic, that there's still a lot of pain, a lot of work to be done still before the economy can recover. And secondly, that the economy may need more help, both on the monetary side. And we've seen this week, the Federal Reserve announced the beginning of two programs, the Main Street, which is for medium-sized businesses, and the corporate buying program, where he's actually buying not just ETFs, but actual corporate bonds. And so those programs just began this week. And then he's also telling Congress, of course, spend more money to take off some of the burden off of monetary policy. Two big numbers this month that have been very positive. One was the jobs data, and one, as you mentioned, was the retail sales data. But the other data hasn't been that great. For example, right after retail sales was reported, so was industrial production. And this really missed expectations, and the back month, April, was revised down. So in effect, what happened is something like this. Through the the $600 a week extra unemployment compensation, and the sort of the UBI, the check that went out to many households, this was able to preserve income levels of the household. For example, one study found that 2/3 of Americans that are collecting this unemployment compensation are making more money collecting the compensation than they did at their jobs. So what was happening is that, of course, in April, when we were all shut down, we were all locked down in our houses or stay-in-place orders, there was nothing to do. You had the income, but no place to spend the money. And so what happened then was that income levels jumped up, but consumption suffered. And that's just the opposite of what we're going to find out next week, where income levels slowed down. They probably stagnated, maybe even declined a little bit, but consumption jumped. And of course, consumption jumped because now people have this money and are going to spend it when they get that opportunity. Go to restaurants, buy some clothes, buy things that they couldn't do because the stores were closed. But it's not coming. This consumption, these things that people are buying, is not coming from new production, but it's coming out of inventories. And those housing starts that were reported earlier today were weaker than expected. And I was kind of surprised how weak they were, because this would be part of the residential construction issues. And you think that a combination of the nicer weather and low interest rates would see this sector come back strongly, which is what a lot of economists expected. They were expecting like over a 20% increase, and we got just a few percentage points. So bottom line here, yes, the U.S. economy passed its worst, but and there might be a short V in the sense of some numbers might spike higher. But what we're really talking about is there's a fiscal cliff and a monetary cliff coming. That $600 a week extra payment, that expires at the end of July. And many of the Fed's programs are only meant to last until the end of September. And so while I think we can be confident that Q3 is going to be better than Q2. And what are we talking about in Q2 in the U.S.? Something like a 35 to 45% contraction at an annualized pace. It's just what a body blow. So I think the Federal Reserve says, look, we've been hit with this big blow. We do think we're going to recover, but we still are looking at almost 10% unemployment at the end of the year. 10%. This was the peak of the 08-09 crisis. And so I think that the challenge for us as investors, as business people, and for policymakers is how much of this impact is temporary and how much of it's going to be permanent. So, for example, some of the layoffs we're already seeing from the banking sector has announced that they're going to go forward with these layoffs. Some of these banks are substantial layoffs, thousands of people. And so I think that I'm trying to be optimistic and say we've passed the worst, but I'm not convinced that of a big V-shaped bottom. I think that it could look like it, because just the numbers, right? You go from a contraction of 35 to 45% to even a flat, slightly positive Q3, and it'll look like a V for the change, but the overall level of GDP, not so big. Ideally, we want to put the money in the people's hands who are going to spend it the quickest. And that's people like you or myself. And that is sort of regular people in the United States who don't have necessarily a high propensity to save, but a much higher propensity to consume. But instead, it looks to me like we're going to be doing a couple of other things. And there's a bill in Congress. The House has already passed a $3 trillion bill. The White House and the Senate are talking about $1 trillion or so. And there's going to be focused on the infrastructure and state and local governments. So it's still this concept. It's kind of weird, but in order to make sure the birds get fed, you got to feed the horses more. That's sort of the logic that's coming from this. And I think that these programs to get people who are having the money, not for investment purpose, but to spend it. I think the government's reluctant to do that. Even at $600 a week payment, many people are saying that offers people a disincentive to go to work. And so that's why they're justifying cutting it and maybe giving people a bonus if they go back to work. There's still, I think this is what Chairman Powell was saying as well, that the Federal Reserve really only deals with big banks, companies, big institutions. Really, they can't really help you or I very much. On the other hand, the government can, but it's reluctant to help the small person out for various reasons, like this disincentive to go back to work, as if there's such a thing really. So I'm afraid that the government policy, fiscal policy, as we saw in 08 and 09, there's many people who don't like the government spending so much money, the high debt levels, and want to cut it back as quick as possible. And so oftentimes I think that they take away the punch bowl too early. We began off this year as the crisis first hit. The dollar began off fairly strong, and it's been weakening against most of the majors, especially like those currencies that are that do well in a risk-taking environment. So that'd be like the Australian dollar, the New Zealand dollar, the Scandinavian currencies, Sweden and Norway, and also some of the major emerging market currencies like Mexico, Brazil, for example. So in the big picture, though, I do think that the dollar, the big cycle is turning, and I think that whether it's the election we have in November or whether it is just the twin deficits, both the current account deficit, large trade deficit, and the budget deficit, I think that these will begin weighing on the dollar on a longer-term basis. So I'm negative on the dollar, but I could see how in the short run, the dollar's had a big setback since about the middle of May, and so I could see a little bit more of a correction as we head through into the end of the half year and end of the quarter.